Hello, my name is Patrick Bartolotto, and I wanted to spend some time today working through an approach to valuation. This is built for my financial statement analysis class, but hopefully it's useful to anyone who has some exposure to financial information. And really, whether or not you've seen or discussed the idea of valuation, I'd argue that if you have the chance to be comfortable with accounting information, talking about revenues and expenses and core ideas of the business, you're absolutely ready to go to learn and master at least the fundamentals of valuation, and then can add in additional topics as needed. So what I want to do is really try to show the natural connection between what we cover in a traditional accounting lens, like financial statement information, and then what we need for valuation. As I do that, what I'm going to have to do is kind of strip away some of the extra steps, like adjustments to adjustments, some degree of peacocking or pretentiousness, where in covering this and talking to numerous professionals and students, it seems like one reason why so many of us struggle with valuation is the process seems to be intentionally inaccessible. I want to break down that barrier, make it a little bit more accessible. And one last thing here is that I don't want this to be an approach of silos of, well, this is a finance thing, this is an accounting thing, whatever else. Really want to integrate and synthesize the existing information. And the good news, hopefully the good news of all this is, if you're comfortable with the idea of, how does a company earn revenue? How do they think about having operating expenses? If you're comfortable with those ideas, the hope is that you can realize that the connection of those ideas, if sound and you have a good, thoughtful understanding of accounting, it's not a big step to kind of see how that stuff is effectively the backbone and the roadmap for valuation. So let's get into it with this introduction. I'm going to have 7 different videos in this series. They're not going to be equally spaced, but hopefully each one is useful. So I'll cover these 7 topics, just to be clear, starting with the first one. So I actually wanted to jump into a perspective from the founder of Patagonia, from an incredible podcast that I spent a lot of time listening to since May of 2023, David Senra's Founders Podcast. And there are hundreds of incredible episodes. I strongly recommend it. But if you want one to start, here's one. He is... the host, David Senra, is covering the impact of Yvon Chouinard. I'm probably mispronouncing his name, but who founded Patagonia. And I just really like this quote that ties together Chouinard's perspective as well as Steve Jobs, because it emphasizes what we want to try to do here. So, what's the role of profitability? And the argument here is that a company needs to be profitable in order to stay in business and accomplish all of its other goals. We consider profit a vote of confidence in our customers to prove what we're doing. We have to be profitable because profits keep the company in business. And I want to emphasize that. So that's a very, a clear for-profit motive, but making a profit is not the goal. As Zen Master would say, profits happen when you're doing everything else right. And then Steve Jobs and David Senra is doing an excellent job of synthesizing different similar people here. Steve Jobs offers the quote of, I was taught by wise people that you manage the top line of your company, that your customers, your products, your strategy, the bottom line will follow. So I want to emphasize all that before I get into the next part I put there in a bit of a highlight. They're both echoing the point of, what is revenue? Revenue is your ability to create value for your customers. And if you do that and you're able to control your expenses, I want to emphasize that is your roadmap for valuation. It's not the complex processes and the somewhat obscure approaches. Just over the course of business, when you're an operator, an entrepreneur, an investor, et cetera, always have that conversation. Not that it's the only thing to think about, but I want to start and focus our time and attention, which is limited, on that. What value do they create for their customers? That's measured by revenue. And then on top of that, what are their operating expenses and how do they go about, achieving operating profitability or controlling cost, if you want to think about it. And then I want to jump in here, kind of the perspective that I want to try my best to encourage you to avoid, both in understanding valuation and then obviously in executing on this if you're the owner operator perspective. If you manage the bottom line of the company, meaning finance first, you forget the rest, you eventually hit a wall, you take your eyes off the prize. And so it ties to the fact that if you have a high quality product and you control your costs, you can't help make profit. Here's what I want to emphasize. The argument is that you're not just thinking about the bottom line the whole time. Think about the way you run your business, conversation around revenues and expenses, which should naturally lead to the bottom line, as opposed to we're all obsessed with the bottom line. We're obsessed with, as I'll mention, the scorekeeping of it all. We kind of miss out on the business behind it. So Our profits directly try to quality of work on our product. If you don't take quality seriously, you'll try to maximize profits by cost cutting. So it's like, there's like long run value destructive ways to try to improve profits, and obviously long run value enhancing ways. And I want to emphasize the second one. Increasing sales by creating artificial demand for goods, hammering the rank and file worker hires, et cetera. Just some examples there. But if you think about the difference here, it's that in the short run, those decisions would increase your company's profitability. But the emphasis here is on, well, yes, but what's the long run, value creating decision? And that's a wonderful way to think about valuation. We're not really trying to consider what will make the company appear more valuable or have higher profits or cash flows in the short run, but what actually creates value with a long run horizon in mind. Quality, not price, is the highest correlation with business success. And then it kind of offers that about the return on investment. So altogether, what's the issue here? The comment here is about, yes, profits are basically your measure of sustainability. Do you have revenues greater than expenses? Guess what? You get to play another round the next year, the next period. You may not have to rely on external financing. You're certainly not going to, that itself is likely going to keep you just, participating, running your business again. So I want to emphasize the value of thinking about profits, about just like core business sustainability, the ability to stay in business, which can lead to the ability to keep employees hired, the ability to provide your customers with value time after time. So emphasize that, but then not just the jump to the scorekeeping at the end of it all, but thinking about the how of generating those profits. The great Kobe Bryant quote is, don't copy what I did, copy how I did it. And that can be applied to any discipline. Another one from, just to give credit to David Senner's Founders podcast, when he's covered Kobe, I think more than once, but, it's just a fascinating way. It's how we do it. I want to emphasize that one more time. I'm definitely keeping it conceptual right now. I want to do that in my intro topic, but I want to kind of get at it's how we do it. Think about revenues and expenses. That's ultimately going to drive profits. Let's kind of redirect ourselves away from just focusing on the bottom line in different ways. And I'm going to show that with cash flows as well. So another way to think about this, Warren Buffett, another Founders episode, excellent one again. The games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. I mean, that's a beautiful way of stating the same thing that I'm working through myself. And then this one kind of gets it. Like, you think about it, valuation is just counting cash. Like, at the end of the day, valuation is just your ability to add, subtract, divide, present value, stuff like that. And not hopes and dreams. So I want to get at, we want to think about, can we ground it? Can we focus on the core business first and foremost? But then can we keep it grounded in, reasonable expectations about the business itself, and not just hopes and dreams or pure imagination? But as Warren Buffett reminds us, we've been taught this since Aesop's time, but we've been taught this since Aesop's time. So there's likely no situation where we're all going to kind of, immediately think about what we should and not get distracted by different shortcuts or stickers or whatever else. So here's a depiction I've created a couple years ago, and I use in all my financial statement analysis classes. And I want to just emphasize this. If you think about it, this is actually a way of looking at a discounted cash flow valuation model with the general idea of driving value. And it's really the first two that mathematically have the biggest impact on company value. So I want to kind of emphasize that piece. But you could really argue there's 5 things that could potentially tweak value. The risk component, capital structure, but is limited in what it can do because it's all still related to your running core operations well, and efficiently utilizing assets. In the olden days, that would probably be bigger when we were more physical capital intensive with human capital intensive. I'm going to argue that the magnitude of that goes down for many companies, but we still have physical capital intensive companies. So keep that in mind. And then the last piece down I kind of emphasize is that cash flows, which we talk a lot about in valuation, they're really not at all related to driving value. They're just how we've decided to measure and count value. And I will cover the discounted cash flow valuation models in this quick lesson. But if you think about it, the business drivers, which is really the beauty and the reason we have accrual accounting, to let us see information about the business drivers, and then we're not done. Just because we have a good accounting system that tells us what's happening and reflects the business reality does not mean, therefore there's value. The balance sheet's not designed to show value, right? The income statement is just showing a particular period. So that's also not the value of the company. Cash flows are the translation of cash flow and valuable for liquidity, but also not value of the company. So all of these are just inputs to valuation. So what's the role of accounting information? To give us inputs to valuation, not to give us valuation itself of a company, but to give us the inputs, the starting point for having that conversation. And again, focus on the core business itself, if I can mention that. The last Founders podcast I'll mention here, just simplest way of referring to it is Senner's coverage on Bill Walsh, legendary NFL coach. Score takes care of itself. I just love that idea of if this goes back to me to Yvon Chouinard, Steve Jobs, Warren Buffett, they're all these brilliant people who've executed, owners, operators, investors, et cetera, have executed on this for decades, kind of getting at that idea of like, look, yeah, if you're good at what you do, your core principles, your revenues and expenses, the rest will be fine. All right. I guess Steve Walsh is giving a coaching perspective of the same idea, not so much specific company stuff there, but hopefully it still works. Here are the valuation steps I want to cover. And I actually want to emphasize that I cover in many ways steps 1, 2, 3, and 4 extensively in our financial statement analysis class. Let me talk a little bit about step 5, but the beauty of this really is if you spend your time understanding the industry, competitive forces, the company's strategy, how that's reflected on their financial statements, and I'd actually say end through their footnotes. I probably should have put that in there myself. Analyze the company's past and firm performance, which is not just summary metrics. Try to be broad and deep and all that. And then if you use all that to motivate your forecast, the nice thing about it is if you did your work in 1 through 5, you're actually going to have not much work to do. And I've created templates and stuff like that. Like if you've done 1 through 5, step 6 is really just kind of math. In many ways, it's not the counting of cash and valuation is the standardized mathematical process. The human-centered part is kind of thinking about the company's performance and everything else. All right. So I want to kind of go back here to actually a different class I teach. It's called Accounting Concepts and Research. And I emphasize in that class to the students that these are, usually, generally speaking, juniors who decide to become our Masters of Accounting students. And right at the beginning, that like, if you're a thoughtful accountant, a phrase I use all the time, if you're a thoughtful accountant, not just, hey, give me rules to memorize, but you're a thoughtful accountant, you think about why we do accounting, which is the focus of that class, you have a big value unlock for thinking about, okay, most applications use financial information. And the thoughtful accountant, as David Sedmer covers extensively in his podcast with Andrew Carnegie, John Rockefeller, Jay Gold, Phil Knight. There's another one I forget off the top of my head, but like people who are trained as accountants, but didn't go on to become accountants. I think in many ways they decided to not be accountants, but the value of that, core focus on the business was essential for their success in their careers. So in many ways, I want to jump back into this. In that class, we talk about like the reasons behind accounting information. And actually one of the things is the conceptual statements, which gets at why do we even have this idea of accrual accounting? I hope at this point you've actually been comfortable. You've seen a little bit of accounting, you've taken an intro class. If not, this might be pretty hard. The best thing you can do to prepare yourself for valuation is take accounting classes and certainly just have a good nuts and bolts understanding of all the pieces. So not necessarily, a deep dive into all the reporting things, but, you understand revenues, operating expenses, operating assets, operating liabilities, that kind of core blocking and tackling of accounting. You're good to go here. But let's just remind us why we have accrual accounting. One, it more closely tracks the occurrence of transaction and other events that would have affected the entity's wealth. So what is another way of saying that? It's like, if you look at transactions, and please check out all of my work in accounting, and kind of covering intro accounting class and everything else, I always try to emphasize it's not about debits and credits. It's about representing the business or economic reality through transactions and having those transactions translate to financial statements. That's not our goal today, but if you need help on that, please let me know or check out my other materials if you can. Is that we're trying to represent the business reality. And if you work through like, why do we do certain things in accounting transactions? It's to do that. But the second thing here is that the accrual accounting system is designed to be complete in terms of, if all we looked at were cash flows, we would miss out on so many core business transactions, sales on account, expenses that are incurred but not yet paid, right? Cash flows alone would say nothing happened, but that's clearly not the case. In addition, a lot of that accounting stuff is actually giving us a depiction or a roadmap for future cash flows. So the comment I've made before, I want to stress it now, is like, it's really this next one here. I'll cover this and I'll get into it. The boards, the Financial Accounting Standards Board, are arguing that basically, if you want to care about the economics, the resources of a company and to change those resources, which ultimately is what we're trying to value, in accrual accounting is actually essential. That accrual accounting understanding is essential to understanding the company's ability or the entity's ability to generate net cash inflows. I'm going to state that differently. And I cover this with basic examples in an accounting class. It's that accrual accounting is designed to give us depictions or a roadmap of future cash flows. Right? There are some with a very unique, I'm going to argue, perspective on accounting, and they talk about it being like just representing the past. That really misses out the point of accounting. If you think about what accounts receivable are, right? Just accounts receivable, not some complex area of accounting, one that's covered in every single intro class. And I do hope you're familiar with that at this moment. That's a representation of future cash inflows from customers. On the other side of the balance sheet, the liability side, what are accounts payable? Those are future cash outflows to suppliers. So even at the most basic intro level, we're getting at the accounting is designed to be forward looking. Yes, of course, it includes the past, but it's forward looking with one very specific and important goal to give us information about future cash flows. Why am I mentioning all this? Just as a reminder that if you're thinking about accrual accounting, it's most of the work we need to do in valuation. So we don't need to redo all that work. We can just remind ourselves that that's a really good roadmap for what we want to cover here. All right. Fun way of saying all that I've covered as I kind of move towards wrapping this up. Forecasting or valuation without understanding accounting or reading the footnotes. Two things I really emphasize in all the classes I try to teach is like throwing darts. And I don't mean random guessing, throwing darts into your own eyes. So don't walk into valuation, with a significant detriment or those darts firmly in the eyes. And I realize that's not the most pleasant image, but I hope it sticks with you, and not in a physical sense, but just like, if you're walking in doing valuation, it's worse than random guessing. And I can give you some data to kind of prove that out if you want with surveys, just that there's so much stuff that we skip or overlook about accrual accounting, and it makes it harder to actually get out there and do valuation of companies. All right. So Ben Graham has issued similar comments from the Intelligent Investor. What is the whole point of that? It's not like some get rich quick scheme or like what's the secret way to whatever or how to hack this or that. No, I love the timeless nature of it. It's just how to think about investing. All right. And then he kind of covers there with language of his day. I would argue that, this isn't the easiest thing for me to work through, certainly. But the combination of precise formulas with highly imprecise assumptions can be used to establish or rather justify practically any value one wishes. And that matters here, right? So it's like we don't want to just be seduced by the fact that, hey, wait a second, I can change this discount rate or this growth rate and get whatever I want. Yeah, that mathematically is going to happen in valuation. But how do we still make sure that we're grounded in what's the company-specific story of revenues and expenses? Not adjustments to adjustments that are going to drive value. All right. So I'm going to set this up as a straw man intentionally, and then obviously give you the answer. Do we value earnings or cash flows? I was doing a podcast with Motley Fool Money. It was fascinating. And we kind of, I don't know if this will ever make the final cut, but when it comes out, I just was making the comment that I don't like this idea that people are like, oh, I'm earnings, I'm cash flows. Like these are sides we're taking. That's absurd. We're thinking about and valuing the business. But more than that, there's a reason we have three financial statements. The reason we have three financial statements is there's not one statement that can give us everything. So should we look at and understand earnings, revenues, and expenses? Of course we should. Should we look at and understand the translation of cash and liquidity? Of course we should. Should we incorporate and think about the balance sheet? Even though the balance sheet is absolutely not there to just give us value of a company. Value of a company is not supposed to be the book value of equity or anything like that. Market value of equity shouldn't be that in most cases, vast majority of cases. So we have three financial statements. Each is giving us incremental information. We're trying to use that information to understand the business. It's not a fight of earnings versus cash flows. It's using information to see how the business is run and then use that to make forecasts and predictions, which we're going to incorporate into valuation. All right. Definitely keeping it conceptual right now. I will get into practical steps just so you know, and cover some other things here. So that's what I want to cover up front, just to kind of set the stage of what we're going to get into. But just to kind of finish this off right now is that think about the business itself, its revenues and expenses. We will get into the technical stuff. I want to talk about discount rates. I want to talk about and cover discounted cash flow valuation models, a variety of different practical tools and applications, but never lose sight of the fact we're talking about valuing businesses. We're talking about their ability to generate value, which is going to be through revenues and expenses. And we're going to talk about and use and refer to how accrual accounting is such an essential step there. And we can also, the last thing I want to mention here, we can actually simplify a lot of accounting. When I get into the DCFs, I'm going to show that a lot of the adjustments to adjustments they're going to offset anyway. We can reduce that. We can reduce the mistakes. We can let us focus on what we care about. How is the business being run? What's its revenues and expenses? And how do we think about what that will be for the future going forward? So stick around. Hopefully this will be valuable for you. I got 6 more of these to go and kind of all divvied up a little bit, but I look forward to covering the rest of them. So take care.